Good morning, ladies and gentlemen. Like Alice, I'm going to be talking about some things that have happened in the past. Although in my case, more recent past, I'm going to be talking about the performance of the ProVen VCTs over the last 5 to 10 years. And as Malcolm said, I'm also going to say a few words about the patient capital review that's being undertaken by the government at the moment. And because I'm talking about performance, I need to give you the usual warning that what's happened in the past is not necessarily a good guide to what's going to happen in the future. So first of all, a quick overview. Find the right. So ProVen VCT is now a smidgen under £100 million in gross assets, 43 investments, of which the largest is Watchfinder. Watchfinder was also the largest investment in ProVen VCT at the time of the shareholder event last year. But since then, it's increased in value by nearly 40% to £8.8 million. ProVen Growth and Income VCT is now nearly 110 million in gross assets, having raised the best part of 40 million in a fundraising during the last tax year. It has 45 investments, of which the largest is now Chess Technologies. Last year it was Third Bridge, but in August we sold the investment in Third Bridge. ProVen Growth and Income realised £12 million in cash from that disposal, which was 85% more than the value we were holding the investment at the date of the shareholder event last year. Is also the largest amount of proceeds that we've ever received from a single ProVen Growth and Income investment. So looking at the performance of each of the VCTs over the last 5 years, this chart shows something called the total return, which is the sum of the net asset value per share plus the total dividends paid during the period, with the light grey bar being the net asset value and the dividends, the blue bar being the cumulative dividends paid. And this is showing the position at the 31st of August for each of the last 5 years, actually 6 years, so you get a 5-year trend. And you can see that the net asset value has stayed pretty constant at around £1, and the total dividends paid have actually added up to 29 pence. So an average annual yield of around 5.8%. And the total return over that period, the total increase in the value of the net asset value per share plus the dividends has increased by about 28% over the 5-year period. The next chart shows the dividend performance. The dark blue bars show the dividend per share for each of the last 4 financial years. And we have a target of paying out an annual dividend yield of 5% per annum. And you can see that in each of the last 4 years, we've either achieved or overachieved on that target. The chart also shows on the right-hand side, the light blue bar, the effective yield for the current financial year based purely on the interim dividend that's going to be paid on the 17th of November. For ProVen VCT, that's 7 pence a share, which equates to a yield just on that interim dividend of 6.6% of the opening net asset value. Similar chart for ProVen Growth and Income. Again, in this case, the net asset value has stayed fairly constant at around 80 pence per share, and the cumulative dividends have been 25.5 pence over the period. But because the net asset value per share is around 80 pence, that means that the average yield is about 6.4 pence per annum over the last 5 years, and the total return performance over 5 years is an increase of 34%. Looking at the dividends, we've again achieved or overachieved the 5% target in the 4 financial years ending in February 2017, and the 10.5 pence dividend that's going to be paid on the 17th of November equates to a 12.4% yield on the opening net asset value per share, purely on that initial interim dividend. Now, last year we introduced something which people have been asking for several years, and that is a comparison of the performance of the ProVen VCTs compared to other VCTs in the market. So I'm going to look at that over both a 10-year and a 5-year period. First of all, over a 10-year period, there are 27 VCTs that have got a track record of at least 10 years. I can't get them all on the chart, so what I've done is I've shown the top 5 performers at the left, then a group in the middle, and then the worst 5 performers at the right-hand side of the chart. And you can see that ProVen Growth and Income is the light blue bar in the middle, and ProVen is the green bar. So you can see that they're mid-range performers alongside VCTs from people like Maven, Albion, and British smaller companies. Looking at the 5-year returns, again, the top 5 performers at the left-hand side of the chart, a bunch in the middle, and then the 5 worst performers on the right-hand side of the chart. Again, ProVen Growth and Income, the light blue bar, is slightly above halfway in terms of performance, and ProVen VCT slightly below. But the worst performer has managed to turn £1 5 years ago into, I think, if I can find the numbers, about 37p, which is going some. What I would say, it's interesting to note that most of the top performers over both the 5 and 10-year period, not all, but most of the top performers have been VCTs that have invested primarily in management buyouts. And it's worth noting that the environment for buyouts has been particularly attractive over the last 10 years. Investors have been able to gear their investments with significant amounts of debt at low interest, thereby boosting the returns on the equity. But clearly, since November 2015, it hasn't been possible any longer to invest in management buyouts. So it'll be interesting to see what effect that has on the performance charts over the next few years. Something else that people ask us about is how we manage the cash performance of the VCTs. So what I've done is to put up 2 charts, one for each of the VCTs, showing the major cash movements over the last 2 years. And I've chosen a 2-year period because over the last few years, each of the VCTs has raised cash on a 2-year cycle. So we need to look at movement in VCTs over that 2-year period. So for ProVen VCT, on the 1st of September 2015, we had £17.6 million of cash in the VCT. Then during the 2 years, we actually generated nearly £32 million of cash from disposals and invested just over £22 million in new investments. So you can see that the proceeds from disposals over this period has been about £9 million more than we've actually invested. And that's a function of the economic cycle. The last 2 years has been a very good period for realising investments, and we've taken advantage of that. But we can't, when we plan our cash requirements, we can't rely on that that environment for realisations continuing in the future. Other uses of cash include around 8 million for operating expenses and buying shares back from shareholders through the share buyback scheme, and about 9.1 million pounds paid out in dividends, which would have meant that had we not raised any cash, then by the 31st of August this year, we would have been down to about 9 million pounds of cash in the VCT. As you know, we did raise about 33 million pounds of cash through a fundraising, and that meant that the actual cash position on the 31st of August was nearly 42 million pounds. The dividend that's going to be paid in November will use up 6 million of that, which will leave us around 36 million pounds of cash, which is hopefully going to be enough to allow us to continue investing over the next 2 years, and also to continue to keep paying dividends, which I'm sure something you'll be very pleased about. This shows the cash position for cash movements for ProVen Growth and Income. Similar thing, we started off 1st of September 2015 with £23 million. We actually raised nearly £43 million from disposals. ProVen Growth and Income has had a particularly strong run of disposals, and that meant that we actually raised about £20 million more from disposals than we invested, despite investing £22.5 million over the period. About £8 million in expenses and buybacks, nearly £10 million in dividends. And then in the start of the current year, or towards the end of the last tax year, we raised nearly £40 million in new cash, which actually left us with an abundance of riches at 31st of August of nearly £64 million in cash. 12 million of that's going to be used up paying the dividend later this month, at which point we'll have about 52 million pounds of cash left. Now we're actually budgeting to invest around 30 million pounds in new investments from ProVen Growth and Income over the next 12 to 18 months, and to keep paying dividends. So although it looks like quite a lot of cash at the moment, that will get used up over the next 12 to 18 months as we make investments and pay dividends. Now, I just want to talk a little bit about the Patient Capital Review, which you may have heard of. This was a consultation launched earlier this year by the government, which looked at the availability of growth finance for innovative companies in the UK. The government did this because they're concerned that a lack of access to long-term capital or patient capital is a significant barrier to the holding back the growth of innovative UK companies. So the other name for the consultation is the Patient Capital Review. The scope of the review was very wide-ranging, but one of the areas they particularly looked at was existing government interventions designed to encourage investment in long-term capital and to encourage entrepreneurship, including the VCT scheme. And what the government wanted to know was how well targeted and how cost-effective each of these interventions was. Now, there's a very strong argument that VCTs are the ideal vehicle to fulfil the government's ambitions in providing patient capital to innovative UK companies. The unique evergreen structure of VCTs means that they can hold their investments for a long time. And indeed, the AIC recently conducted some research which showed that 20% of the companies they surveyed had received their first VCT investment more than 10 years before. This is in stark contrast to a typical limited partnership venture capital fund, where the fund has a maximum of 10 years both to invest the capital and then to realise all the investments and return cash to shareholders, the underlying investors in the fund. So VCTs are a much longer term investment vehicle. However, the Treasury was concerned that some of the money raised by VCTs is not going into those early stage high growth companies that it wants it to go into, but instead it's going into low risk asset backed investments. And they were also concerned that VCTs are more expensive for the government than some other interventions because of the tax relief, and also because their belief that not all the money being raised by VCTs was actually being invested. Beringea took a very active role in participating in the consultation, as well as submitting our own written submission to the Treasury. We also made a major response to the submission made by the Venture Capital Trust Association, which is a new body set up by the managers of the 10 largest VCT funds. And we also participated in the submissions made by the AIC and also by the British Venture Capital Association. And the VCT Association was able to demonstrate to the Treasury that the changes in the rules that were made in November 2015 have been extremely effective in retargeting VCT investment at those early stage high growth businesses. Research carried out by the VCTA showed that since November 2015, the companies in which their members have invested have had an average turnover of £3 million and an average number of employees per company of 40. We were also able to demonstrate that because the proceeds of investment disposals can be recycled into new investments, VCTs have on average actually invested £1.30 in companies for every pound that's been raised from investors, which means that they're much better value for the government than they originally thought. I've been involved in a number of meetings with the Treasury, and as a result, it's now my belief that the Treasury has a much more positive view of VCTs than they did at the start of the consultation. Nevertheless, it is still highly likely that there will be some significant changes to the VCT scheme, and they're going to be announced in the budget on the 22nd of November. I have absolutely no knowledge of what those changes are going to be. The Treasury's played its cards very close to its chest. But I am hopeful that the government will recognise the valuable roles that VCTs can play in supporting high-growth, innovative UK companies, on which the future prosperity of the UK will, in large part, depend. So that's it from me. I'd now like to hand over to our Chief Investment Officer, Karen McCormick, who's going to tell you some more about some of the developments in the portfolio and also share some thoughts on the current background for VCT investing. Thank you.